There's a lot of buzz out there on the internet referencing how do I pay off my 30-year mortgage in 5 to 7 years. Today I'm going to be sharing some insight on whether or not you should pay your 30-year mortgage off in 5 to 7 years. As a mortgage lender, I have been helping people accomplish their financial goals for over 25 years. So listen up, this one's going to be good. Okay, so paying off your mortgage in 5 to 7 years, yes or no? It depends on what your particular scenario is, what your goals are. Do you have children? Are there health care things that you are working on? Do you have some of the basics in place? This is the thing that I think that really starts to get people off track, because it's like anything, it's a trend. You know, you're at a dinner party, you're talking to somebody and they're all about, oh yeah, well if you did this, you could pay off your mortgage in 5 years, 7 years, 10 years, 20 years, whatever it is. But here's the deal. The real question is, should you? And my answer is, it depends on your particular scenario. First, let's address some of these schemes and crazy thoughts that are out on the internet about how people leverage certain tools to pay down or pay off their mortgage sooner. So the bottom line is, there's stuff out there about how using a home equity line of credit could essentially pay off your first lien position mortgage sooner. There's other things out there about how to leverage zero interest credit cards and how you can use that and leverage it daily and pay off your mortgage sooner. Here's the bottom line. All of that has risk. If you're in a 30-year fixed rate, you're controlling your risk, and you can control how and how much to pay towards your principal if you want to pay that loan off sooner. And if that's really your goal, which I'm not advocating that it should be until I know more about your personal situation. So I get all kinds of phone calls. Hey, Kelly, I want to refinance. I want to lower my term to 10 years or 12 years or 15 years because my goal is to pay off my house. Before we get into that, I want to really take our borrowers deeper into, let's talk about their particular scenario. And that is, do they have children? Do they have money set aside for college? Are they paying daycare? Is there somebody sick in the family that there's medical costs that are exorbitant? Because let's face it, there are medicines and costs with regard to medical treatment that are very expensive, that aren't necessarily covered by insurance. So this really comes down to a personal, particular situation based on what's going on in a person's life. And as we all know, just like a fingerprint, there are no two fingerprints that are the same. There are no two personal scenarios or stories that are the same either. So I always advocate, first, let's look at your financial scenario. Let's get into some of the basics before you start to go down this path of paying off your mortgage in 5 years or 7 years. First, understand what your monthly survival number is. And that means all of your expenses, including your housing expense, your minimum cost for your credit cards, your car, insurance. What does all of that look like every month? So that's the first step. Know your numbers. Then once you know what your monthly survival number is, step 2 is prepare and save for a 3 to 6 month rainy day fund. Because let's face it, sometimes storms happen in one's life. And if you have worked and focused on paying off your mortgage in 5 years, but you don't have a rainy day fund, it's not going to matter, because all that money in your equity of your house is not easily accessible. So before you get to that, we've got to stay focused here. 3 to 6 months in a rainy day fund. That's just money that you've set aside. It goes into a savings account that you don't touch. That's in case something happens in your life and you need to access it. You can survive for 3 to 6 months. Then we're going to start to look at, what are your monthly debt obligations? If you have credit cards, that's going to be the next major focus of paying off those credit cards. And once they're paid off, keep them paid off every month. Even if you use them, again, pay them off every month. Once the credit cards are paid off, now we're going to look at student loans. Why? Why am I advocating paying off credit cards and student loans versus focusing on paying off your mortgage in 5 to 7 years? because the average interest rate on credit cards and student loans can be anywhere from 6% to 22%. That's crazy. Whereas on a home loan, depending on the amortization in today's market, that could be anywhere in the high 2s to mid 3s. And it's a fixed rate. Credit card rates are not fixed. So we want to really start to focus on the segments of where your expenses are and how to attack getting whole and corrected, and how to attack getting those things under control first. So paying off credit cards, getting your student loans paid off. The next thing is, are you saving? Do you have a nest egg? Do you have money set aside? So the next place to start, if that answer is no, is if you work for a company where you have access to a 401k, max it out. Max it out every year. Now you've got money that is being automatically deducted pre-tax into a retirement plan. So now you've got money growing. And that again will be for your future. After the retirement fund is committed to, are you saving any other portion of your monthly income? Now this is where it starts to get, if you are saving and you have extra money every month, what are you doing with it? If your goal is to pay off your house, then I'm all for it. I'm all for taking that money after we've taken care of the survival number, the rainy day fund, no credit card debt, no student loan debt, and a savings, an automatic savings type of vehicle, such as a 401k. Once all of that is in place and in motion and has been, if you have extra money every month and you've decided that your goal is to pay off your house, then go for it. Absolutely. But don't get distracted by all of this noise out on the internet about using this to leverage that. Guys, here's the deal. If one thing goes wrong, one thing, let's say that home equity line of credit gets frozen, then what? Let's say your credit card, you have a 30-day late payment on it because you're on vacation and you just happen to miss it. One thing like that can change those schemes and that advice that you're being given to a whole different type of outcome. So I'm advocating basic financial types of building blocks. That's where we want to start. And then if you, after that, are in a position that you want to pay that house off, let's take a peek at it. Are you on a 30-year fixed rate? Does it make sense to refinance to a 10 or a 15-year fixed rate? Once you're there, how much is it going to take every month to pay that loan off in 5 years or 7 years? There's always a way around how you can do that and do that in a safe, orchestrated manner. So the critics will say this is old-fashioned financial advice, and maybe it is, but I have been lending for 25 years and I see all the time that people want that fast type of quick response. They want that quick result. Well, when you're building wealth, it doesn't happen overnight. There is no quick, like do this and this is going to happen. It's kind of like being on a health and fitness plan. When you start at the gym, you're not going to drop 20 pounds overnight. That's not the way it works. It takes an orchestrated effort, plan, and discipline to really achieve your health and fitness goals. And it's the same way with your financial goals. You have to have a plan that makes sense based on your particular scenario. And then once you have that all orchestrated and laid out with discipline, constant focus, intentionality, then it will lead you to where you want to go. And if paying that house off makes sense, then great, good job, go for it. But don't go pay the house off if you don't have any money in the bank and you have no savings. You don't have a rainy day fund. You've got $30,000 in credit card debt. Paying the house off is downstream. It's not the first thing you want to focus on after you've taken out a home loan. So paying your house off in 5 to 7 years. People in the internet or at the cocktail party, they talk about this stuff because it's sexy. It's fun to say, it's fun to think, oh my gosh, how would my life be if I didn't have a house payment? Okay, I love it. I love that thought. My advice is make sure you have your ducks in a row. Make sure all these other foundational parts of the plan are in place before you go decide to pay off your house. It's easy to get caught up in all of the noise and the excitement and the spin and, oh yeah, I'm going to be house debt free. There's a place and a time for that. It's not for everybody, depending on where you are in the process. So that's it. Now you have some additional information to help you decide if you should pay off your 30-year mortgage in 5 to 7 years. Remember, it's always recommended to work with an experienced mortgage lender and a financial planner. If that's in Arizona, California, or Colorado, please feel free to reach out to me. I am a licensed mortgage lender and would love to be able to guide you through this process. And don't forget, like, share, and subscribe. We'll see you next time.